What's going on, guys? Today we're going to be talking about self-employment income or self-employment clientele that you need to qualify for. So, being in this industry over 10 years, I would tell you self-employment income has to be one of the most challenging clients that you can qualify for a home mortgage. When I first started out, it was like pulling teeth, with finding a right program or having to ask clients to wait another year to be able to qualify, right? And what I would tell you is there's so many different loan products that you can qualify your self-employed clientele more than ever. So you shouldn't be able, or you shouldn't have to turn down a deal because, again, there should be more options. And just depending if you're on the retail lending side or you're a mortgage broker, again, there's always flexibility, right? So I'm going to talk about a handful of, scenarios, and hopefully this helps you guys out. First thing is first, you always want to try to qualify your self-employment clientele with tax returns because that's when they get the best rate in term most of the time, especially with primary residence. It makes a big difference, right? Because that's, talking about stated income, which means that you're not using tax returns, could be like a half a point higher in the interest rate, right? So again, you always try your best to qualify them with their tax returns. How this works is traditionally, you're using 2 years tax returns average. And what you're looking for is the 2 years tax returns. Let's just say, for example, 2023 and 2024 tax returns. You're looking if the business is making more money than the previous year, if the business is like pretty much growing, right? Because again, if the business is declining, what happens is, always think about this. The underwriter, the lender, the bank, whatever you want to call it, they're always going to take the conservative number, meaning the lower income amount, right? Because they don't want to take any chances. God forbid, business tanks and they can't afford the house, right? So again, they're always going to take the conservative number. Always place that in your head, conservative number. So that means that if 2023 tax returns, let's say, for example, net income was 100 grand, and then 2024 was 125 grand net income, you're going to take those two numbers and you're going to average it, take an average of 24 months. You're going to add them together, divided by 24 months. That's your net income that you can use monthly, right? Now, if the income, like let's say 2023 was 100,000 and 2024 was only 90,000, guess what? That means the business is declining and you're going to use only 12 months, meaning you're going to take 90,000 only as their income and you're going to divide that by 12 months, right? So again, they're always going to take, the underwriters are always going to take the conservative number. So just always make sure you look at that. It's always good to look at both years. Now I'm going to throw a twist in there for you. If your client has owned the business for over 5 years, and their credit score is, like 700s or even 680 sometimes, depending on the, desktop underwriting or the AUS findings, you might be able to use 1 year tax returns. And that's what I usually, do for my clients that's been in business for a long time or else has been a self-contractor for a long time. I will, if they have like 1 good year, or else maybe they are going to have 1 good year, quote unquote, you can just use 1 year tax return, but you have to go conventional financing. Government loan like VA, FHA, you have to take 2 year tax average no matter what. But conventional, little tip trick, you can go 1 year tax returns as long as they've been in business for over 5 years. All right. So again, and that's mostly LPA, which is Freddie Mac. So just FYI on that. So the next thing is, people don't pay attention to. What I notice is the meals. When you look at the tax returns, doesn't matter what kind of tax filing they do for the business, either they're a sole proprietor, Schedule C, or they're 1120 S Corp, or they're a corporation or a partnership. If there's meals, you have to deduct that from their income. So very, very important to pay attention to that. Always look for all the additional expenses, right? And make sure that there is no meals that's being calculated in there because you have to deduct that from your net income. And a lot of people don't know that. Second thing I would tell you is business miles. Business miles for a sole proprietor, self-contractor, 1099 employee, when they write it off, they can put business miles. You can add business miles back. You take business mile times 27, what's it? You take the business mile times 26 cents per mile, and you can add that back as income. And every year it changes, guys, so don't quote me on that. It was 25 cents 1 year, and I think this year is 26 cents per mile, right? So again, you can add miles back. Another thing you can add back is depreciation. That's huge. Depreciation you can add back. And again, that goes for all business tax filings, sole proprietor, S corp, partnership 1165, a corporation 1120. So again, you can add that back. Another thing I would see is, there's people that issue themselves W-2s, especially those that have corporations. They'll issue themselves W-2s, and you can add that back too. So again, there's so much income that you can add back. People don't realize. The one that I've been seeing recently that's pretty awesome, home office. Home office is something that people can add back, especially their sole proprietor or 1099 contractor, right? So a little tip on that as well. Now, if your clients don't have good tax returns or they don't want to file their taxable income higher, there's alternative routes. And that's the cool thing about this, this current time period. You can do a bank statement loan, a 12-month, 24 months bank statement loan. What happens is the underwriter or the lender will use a average of the monthly deposits, as long as they're consistent deposits, right? So consistent deposit means like they say, for example, own a restaurant or a gas station and its monthly is about whatever. As long as it's consistent, it's not like one big old lump sum of $100,000 deposit. It has to make sense for the lender to use that income. But usually they'll take an average of 12 months and divide that by 50%. There's ways to get around that. If you need more income besides the 50% expense factor, if you're able to obtain a CPA letter and they will issue hey, look, the expense for this business is only 20% per year, they can use that, right? It has to be signed by the CPA or sometimes even a P10, right? Tax preparer. So tips on that as well. I would say the second option for a self-employed clientele is 1099. If they're a 1099, and a realtor is a perfect example. I've done a 1099 program for one of my realtor partners, and it worked out perfectly. With the 1099 program, they'll take 2 years to make sure they have the 2-year history, and usually they'll take 90% of the 1099. So there's a 10% expense factor that they use. So again, just keep in mind with the non-QM, bank statement loans or this 1099 product, most of the times the down payment is higher, right? The down payment is higher, meaning it's more than 10% or more. So just always keep that in mind. And the name of the game with non-QM, guys, so you guys know, is that the more money you put down as a down payment, the higher your credit score is, the better the interest rate you'll get, the better the rate and term that you'll get. Okay, so always keep that in mind. And usually it's a 50% debt to income ratio max that they will let you have. Some lenders will go up to 55% debt to income ratio. So definitely check out the lenders, because every lender has different guidelines, right? The third one I would tell you is the profit and loss program. That's been amazing. As long as the CPA creates the profit and loss of 12 months or 24 months profit and loss, that's something, and they sign off on it. That's a great program as well. No tax returns needed, no 1099s needed, no bank statements needed. Sometimes, most cases, some lenders need 3 months for the profit and loss, but other lenders don't, right? So again, check with your lending partner or banks that you work with, right? The 1099 program, one thing to know is like they will, at the end of the loan, once you get clear to close, they will reach out to your CPA to vouch one more time. So that's key. A lot of people don't think about that, but always be, always be on and prepare the CPA, prepare the borrower to reach out to their CPA to press the urgency to pick up their phone or respond to the email, right? I would say those are the 3 ones that I would recommend for self-employed clientele. There's, again, these programs that we talked about, you can do refinance, rate and term. You can do refinance, cash out. You can do purchases. So again, it's so flexible, and give you some ideas or give you just some thoughts. You can use it to sometimes pull out equity to put a down payment on another house, right? So again, try your best to think outside the box. Again, credit scores will vary depending on the lender, but these are some great programs or, tips and tricks that you can use when you're qualifying borrowers. And I would say, that's pretty much, sums it up for now, but hopefully you follow us. We'll be dropping more dimes and knowledge with you in the near future. Thanks.
Hopefully you subscribe to the channel.
Hopefully you subscribe to the channel. So please subscribe to the channel if you want more good tips like this. We're always trying to give back value. So again, please subscribe. And if any questions, comments, please comment below.